You've probably heard people say stock charts are only for the pros, and they're designed to confuse regular investors. But here's the twist: they're not as complicated as they seem. In fact, these charts are the key to making smarter investment decisions, and today, I'm going to prove it. Welcome to Stock Market Stories. Today, we're breaking down how to read a stock chart, an essential skill for anyone looking to invest smarter. Whether you're just starting out or looking to sharpen your skills, I'll break down how to read stock charts step by step. Let's turn that confusion into confidence and get started. A stock chart is essentially a tool to track a stock's price movements over time. Think of it as the story of a stock's performance, where it's been and where it might be headed. For investors, it's like a report card, helping you analyze trends, understand price changes, and make informed decisions. There are a few types of stock charts, each with its own style. Line charts are simple, showing only the stock's closing price over a given period. Bar charts add a little more detail by including the opening, closing, high, and low prices. Then, there are candlestick charts, which are incredibly popular because they pack a lot of information into one visual. We'll focus on candlestick charts in this guide, since they're the go-to choice for most investors. Now that you know what a stock chart is, let's break down its key parts. Once you get these basics, charts will stop feeling confusing. The time frame shows how far back the chart's data goes. A one-day chart tracks daily movements, while a one-year chart shows long-term trends. Day traders prefer shorter time frames like 1 or 5 minutes, while long-term investors look at weekly or yearly views for broader insights. Candlesticks are the most popular way to display prices. Each candlestick represents a specific period, like a day or an hour. Green means the stock closed higher than it opened. Red means it closed lower. The wicks show the highest and lowest prices during that time. Together, candlesticks give a clear picture of price movements. Volume bars show how many shares were traded in a given period. High volume often means strong investor interest, especially during major events like earnings reports. Price increases with high volume signal strong buying, while drops with high volume suggest heavy selling. Indicators, like moving averages, help you spot trends. Short-term averages, like the 20-day, track quick shifts, while long-term ones, like the 200-day, show broader trends. Indicators simplify analysis and make patterns easier to spot. Master these basics, and you'll be reading stock charts with confidence in no time. Next comes trends. When it comes to stock charts, trends are the bread and butter of analysis. They help you understand the general direction a stock is moving and offer clues about where it might be headed. Let's break down the 3 main types of trends. An uptrend occurs when a stock consistently makes higher highs and higher lows. This is a sign that the stock is gaining value over time and is typically considered bullish territory. Imagine a staircase climbing upward. Each step represents the stock reaching a new high before briefly pulling back and then pushing higher again. Uptrends are what most investors look for, as they indicate positive momentum and strong buying interest. A downtrend is the opposite. It's when a stock makes lower highs and lower lows. This pattern suggests the stock is losing value over time, and it's considered bearish territory. Think of it like a slide at a playground. Each dip takes the stock lower, with only small, temporary recoveries. Downtrends often reflect selling pressure and can indicate trouble ahead for the stock. Sometimes, a stock doesn't move clearly up or down. Instead, it hovers in a tight price range, creating what's known as a sideways trend. This is often a period of consolidation, where the stock is gathering momentum before its next big move, either up or down. It's like a calm before the storm. Sideways trends can be tricky to interpret, but are worth watching closely. as they often precede a breakout. To confirm any trend, look for at least 3 consistent data points showing the same movement. For example, 3 consecutive higher highs in an uptrend or lower lows in a downtrend. Keep in mind, though, that trends aren't guarantees. They're guides to help you make more informed decisions. Now, let's take what we've learned and apply it to a real stock chart. For this example, we'll look at Apple's 6-month performance. First, check the time frame. Here, we're looking at 6 months. This gives us a good balance of detail and broader trends. Next, notice the price trend. Over these 6 months, Apple shows a clear upward trend with occasional pullbacks. Each pullback represents a brief period of selling, but the stock consistently pushes higher, confirming the uptrend. Look at the volume spikes. These align with significant events, like quarterly earnings reports. For instance, after a strong earnings report, there's a noticeable volume spike paired with a price surge. This combination signals positive investor sentiment and strong buying interest. Finally, overlay the 50-day moving average. This line smooths out short-term fluctuations and highlights the stock's overall momentum. In Apple's case, the price stays above the 50-day moving average for most of the period, reinforcing the bullish trend. By analyzing this chart, you can see how trends, volume, and indicators work together to tell a story about the stock's performance. It's a practical example of how to use the tools we've discussed to make sense of real market movements. Now, if you think you've got it, here's a heads up for you. When starting out, it's easy to fall into certain traps that can derail your progress. Let's go over some common mistakes so you know what to watch out for. One of the biggest mistakes beginners make is overloading their charts with too many indicators. It's tempting to add everything: moving averages, Bollinger Bands, RSI, MACD, but this can create a cluttered, confusing mess. When your chart looks more like a scientific experiment than a tool for analysis, it's time to simplify. Start with the basics: price, volume, and maybe 1 or 2 indicators. Once you're comfortable, you can gradually incorporate more tools as needed. Volume is like the heartbeat of the market, and ignoring it can lead to misjudgments. Price movements without corresponding volume can be misleading. For example, if a stock's price jumps but the volume is low, it might just be a temporary blip rather than a meaningful trend. On the other hand, high volume paired with significant price movement often confirms that the market is genuinely interested in the stock. Always check the volume to validate what you see in the price action. Jumping into a stock purely because it's trending is another common pitfall. Just because a stock is on the rise doesn't mean it will continue to climb. Without understanding the context, like what's driving the trend or whether the stock is overvalued, you could end up buying at the peak and watching it fall. Always take a step back and assess the bigger picture before making a move. To wrap things up, here are some practical tips to help you build your confidence and sharpen your chart reading skills. Focus on the basics first: price, volume, and trends. Once you're comfortable with these, you can gradually introduce indicators like moving averages or RSI. There are plenty of free platforms like TradingView or Yahoo Finance where you can practice reading charts without spending a dime. These tools are user-friendly and perfect for beginners. Stock charts are just one piece of the puzzle. Combine what you see on the chart with the company's fundamentals, like earnings, revenue growth, or market conditions, to make more informed decisions. Use stop-loss orders to limit your risk. This way, you can automatically sell a stock if it drops below a certain price, protecting your investment from unexpected losses. Track your trades, including what you observed, why you made the decision, and how it turned out. Over time, this habit will help you identify patterns in your own analysis and improve your strategy. And that's how you read a stock chart. It's not about perfection, it's about progress. So take your time, practice, and keep learning. If you found this helpful, let me know by giving it a thumbs up and subscribe to Stock Market Stories for more beginner-friendly investing tips. And hey, if there's something specific you want to dive deeper into, drop them in the comments below. Thanks for watching, and we'll see you in the next one.